Welcome to the Daily Drawdown with enterprise tech strength, AI risk, biotech deal heat, and a 529 shift. The market's telling a more mature story now. Money is moving away from the loosest AI trade and toward companies showing real enterprise demand, while a few crowded winners are starting to look priced for perfection. Dell put up an extraordinary quarter with enterprise revenue up 92%. And the important part is that the strength was described as durable and broad-based, not just a one-product GPU burst. That matters because it supports the idea that enterprise buyers are actually spending and that the AI build-out is broadening into infrastructure and hardware with repeatable demand. Analysts also read Dell's guidance as conservatively low, which is why some see the stock as still undervalued even after the recent run and argue for larger position sizing. The bigger market read-through is a rotation toward enterprise software and hardware. Microsoft is leading, NVIDIA has gone flatter, and the message is that investors want proof of adoption, not just AI excitement. The macro backdrop is helping too. Lower oil prices and falling yields are easing inflation expectations, which improves the setup for growth names like Dell and Cisco. On the other side of that rotation, some chip names are looking more fragile. Micron's near 90% rally is being flagged as more vulnerable to overshoot, especially compared with companies that have a cleaner enterprise demand story behind them. Broadcom is another name drawing caution. The earnings beat was only modest, but options flow was heavily bullish, with calls running about 2-to-1 over puts and roughly $500 million in premium betting on an about 8% move. That kind of positioning can amplify moves both ways, and it's landing on top of real concentration risk. About 4 customers account for around 40% of Broadcom revenue. When a stock is valued close to perfect, even a small growth miss can hit hard. So this is where hedging and tighter risk controls start to make more sense. A lot of richly priced tech now depends on AI delivering measurable efficiency gains, and that creates a different kind of downside risk. If companies build AI into the story faster than they build it into the numbers, valuation gets exposed very quickly. The spread of AI-linked revenue streams is still a tailwind, but it also feeds FOMO, and that can reverse fast if deployments disappoint or monetization slips. Apple is the clearest pressure point here. Siri is still viewed as underwhelming, and there are real questions about whether Apple can turn AI into meaningful monetization without a breakthrough product. Microsoft looks stronger, but it is not exempt. Part of the rally is broad tech momentum, and the company still has to prove AI integration can drive durable growth at scale. After 5 months of outsized returns, veteran investor Michael Farr is making the simple point that tends to get ignored late in a run rebalance. He's warning against chasing astronomical moves without risk controls because that usually feels smart right up until it doesn't. Practically, the takeaway is basic but important. Manage position size, trim back what's run too far, and use hedges where valuations leave no room for error. Robinhood had a roughly 11% weekly gain as its AI-driven trading tools showed early traction with active retail users. That suggests the product is resonating with exactly the audience Robinhood needs most, but the open question is durability. The company is also building infrastructure to handle high-profile accounts, including Trump accounts, and that could open a new revenue stream. The pushback is straightforward. Fees are still seen as high, and critics doubt AI trading tools alone can support long-term growth beyond the active retail crowd. In biotech, ASCO is shaping up as a major M&A catalyst, with expectations for around $75 billion in deal activity as drug makers race to refill pipelines. Antibody-drug conjugates are a prime target because they offer targeted efficacy with the potential for fewer side effects, which is exactly the kind of asset big pharma wants to lock up. Names like Eli Lilly and Pfizer are pursuing multi-billion-dollar deals, and the urgency is tied in part to monetization pressure from the Inflation Reduction Act. So this is not just conference buzz, it's a pipeline and policy response, and it keeps the biotech M&A backdrop very live. One practical policy change worth noting, 529 plans can now be used for credential program tuition, licensing fees, and continuing education costs, and beneficiaries can be changed to adults. That makes the account more useful for career transitions, reskilling, and layoffs, especially for workers who need a tax-advantaged way to fund training. The catch is that tax-free treatment still depends on the program qualifying through authorized agencies, so the planning detail matters here. The key shift today is pretty clear. Proven enterprise demand is gaining ground, while crowded AI and chip trades face a tougher standard. That's the brief from the Daily Drawdown. This episode was generated by Podkey. Create your own at podkey.fm.